As of the market close on Friday, December 26, 2025 at 4 p.m. EST, NuScale Power Corp, trading under the ticker SMR on the New York Stock Exchange, finished the session at $14.85. This represents a significant decline of $1.23, or 7.65% for the day. While the headline number is a sharp drop, what is actually happening beneath the surface is a classic tug-of-war between speculative momentum and the cold, hard reality of commercial scaling in the nuclear sector. Most people look at a 7% drop and assume it is just a bad day for small-cap energy, but the reality is that the market is beginning to question the massive gap between the hype surrounding small modular reactors and the actual revenue generation timelines that companies like NuScale are presenting. You might think that because the world is desperate for carbon-free baseload power to feed massive data centers, every nuclear stock should be a straight line up, but the price action on SMR today tells a much more nuanced story about investor exhaustion and the high cost of waiting for a theoretical future. The immediate driver for today's sell-off appears to be a combination of institutional rebalancing as we head into the final days of 2025 and a lingering hangover from the recent shareholder vote regarding share authorization increases. When a company like NuScale asks to potentially issue more shares, the market immediately smells dilution, even if the capital is intended for genuine project advancement. Investors who are using platforms like Interactive Brokers or the Robinhood app are seeing this volatility play out in real time, often without the context that nuclear projects are measured in decades, not quarters. If you were looking at your Fidelity brokerage account today and wondering why SMR was bleeding while the broader market seemed stable, you have to look at the massive run-up this stock had earlier in the year. The expectation was that by late 2025 we would have seen more concrete groundbreaking announcements, yet the reality is that we are still deeply entrenched in the engineering and licensing phase. This brings us to a critical point about the current market sentiment. There is a common belief that NuScale is the clean energy version of the NVIDIA stock of 2 years ago, a company with a monopoly on a critical technology that everyone needs. While NuScale does have the only small modular reactor design with NRC certification, the market is starting to realize that being first doesn't mean you're fast. The expectation was a smooth transition from R&D to commercial revenue, but the reality is that the company just reported a staggering net loss in its most recent quarter, missing analyst estimates by a wide margin. When a company loses nearly $2 per share against an expectation of a few cents, the narrative shifts from future leader to capital-intensive risk. This is why even those utilizing sophisticated tools like Schwab Intelligent Portfolios or Fidelity Wealth Management are often advised to treat these names with extreme caution despite the massive potential upside. If you look at the trading volume today, it was nearly 60% higher than the daily average. This isn't just retail panic, this is institutional volume. We are seeing large blocks of shares moving, which suggests that some big players are trimming their positions after the stock failed to maintain its 50-day moving average. For anyone involved in self-investing or using investing sites to track these movements, the technical breakdown below $15 is a psychological blow. It's a level that had acted as support throughout the autumn, and breaking it on high volume suggests that the buy the dip crowd is finally feeling the heat. At this point, I want to hear from you. Comment below how many shares of SMR you are currently holding, or if you have moved your capital into more stable nuclear plays lately. To understand why the stock is behaving this way, we have to look at what NuScale actually does and how its business model differs from traditional utility companies. NuScale isn't just building a power plant, they are trying to change the way nuclear power is manufactured. Their core product is the NuScale Power Module, a 77-megawatt reactor that is intended to be built in a factory and shipped to a site. Think of it like a prefab home, but for carbon-free energy. The idea is that by mass-producing these modules, you can avoid the multi-billion-dollar cost overruns that have plagued large-scale nuclear projects for 50 years. In theory, this is brilliant. In practice, the first major project they had in Utah was canceled because costs rose too high, and now they are pivoting towards projects in Romania and a massive partnership with the Tennessee Valley Authority. The TVA deal is the expectation that bulls point to. It's a massive agreement that could eventually see 72 of these modules deployed across the region, but the reality is that the first of these won't be operational for years. For an investor using a SoFi active investing account or a Robinhood investment strategy, waiting 5 to 7 years for the first real revenue to hit the books is a lifetime. During that time, the company has to keep the lights on, pay its engineers, and continue navigating the most complex regulatory environment on the planet. This requires cash, lots of it. Earlier this year, NuScale tapped into an at-the-market equity program to raise nearly $500 million. While that bolsters the balance sheet, it also means that the piece of the company you own just got a little bit smaller. The institutional activity we've seen lately shows a clear divide. On one hand, you have firms like Triumph Capital acquiring new stakes, betting on the long-term inevitability of nuclear energy. On the other hand, we've seen significant insider selling, including the CFO offloading nearly half of his direct holdings in December. When the people running the company are selling at $22 and the stock is now at $14, it sends a signal that they might believe the market had gotten ahead of itself. For those using online investing tools or the Fidelity mobile app to track insider trades, this was a red flag that many retail investors chose to ignore in favor of the AI power demand narrative. Speaking of AI, that is the current engine driving the expectation for NuScale. Companies like Microsoft and Google are looking for massive amounts of power that doesn't rely on the weather. The narrative is that NuScale will be the primary provider for these data center microgrids. However, the reality is that the power grid is a stubborn beast. You can't just plug a small modular reactor into a data center and expect it to work tomorrow. There are transmission issues, cooling requirements, and local zoning laws that don't care about the latest tech trends. While the long-term outlook for nuclear remains very strong, the market is currently in a phase of punishing companies that don't have immediate cash flow. Looking at the broader sector, we see similar pressure on names like Oklo and Centrus. The nuclear trade was the darling of the market for most of 2024 and early 2025, but the reality of the timeline is setting in. If you are using SoFi ETFs or looking for Fidelity mutual funds that focus on clean energy, you'll notice that the weighting of these speculative nuclear names has been volatile. The smart friend advice here is to realize that NuScale is essentially a venture capital play disguised as a public utility stock. It has the potential to be a 10-bagger, but it also has the potential to languish for years if they can't prove they can actually build these things on time and under budget. If we look at the financial health, the company ended the third quarter with about $750 million in cash. That is a solid cushion, but when you're burning through money to fund engineering and licensing, that cash can disappear fast. The most recent earnings report showed that while revenue is up, mostly from engineering fees for the RoPower project in Romania, the net losses are still widening. For someone using online investment platforms to screen for profitability, NuScale doesn't look great. But if you're using an individual brokerage account to speculate on the future of the global energy grid, you are looking at different metrics, like the progress of the NRC's approval of their uprated design. The future outlook for NuScale hinges on two major catalysts. First is the final investment decision for the project in Romania, which isn't expected until late 2026. Until then, the stock will likely trade based on headlines and macroeconomic shifts rather than fundamental earnings. Second is the potential for government legislation or subsidies that favor small modular reactors. The Department of Energy has shown interest, but interest doesn't always equal checks in the mail. If the reality of government support fails to meet the expectation of a massive federal windfall, the stock could see further downward pressure. As we move into 2026, the contrast between the expectation of a nuclear-powered AI future and the reality of slow construction will be the dominant theme for SMR. Those who are self-investing need to decide if they have the stomach for the 7 to 10% daily swings that have become common for this stock. If you're using the Robinhood trading platform or the Interactive Brokers platform, you have the advantage of speed, but speed can be a double-edged sword in a stock that is highly sensitive to every news bite. The institutional sell signals we saw today might be a precursor to a quiet January, or they could be the final washout of speculative hands before a recovery. To summarize the situation, NuScale is a company that has successfully achieved what no one else has, NRC certification for an SMR. That is a massive moat. However, the reality of their current financial performance is a stark contrast to the optimistic valuation the market gave them earlier this year. The 7.65% drop today isn't just a random fluctuation, it's a recalibration of what investors are willing to pay for a promise that is still several years from completion. The expectation of immediate relevance in the AI energy space is clashing with the reality of heavy capital expenditures